So to kick off our summit this morning, we welcome Nick McCoy, co-founder and managing director with Whipstitch Capital, the largest independent investment bank in the United States, solely focused on the better for you consumer sector. Nick has over 20 years of investment banking experience and has worked with Whipstitch co-founder Mike Bergmeyer since 2008 at a previous investment bank that Nick also co-founded. Previously, Nick was in the investment banking group at First Albany, which is now Jefferies, the director of M&A at All America Financial Group, and a senior associate corporate development at Wheelabrator Technologies. Nick often speaks and is quoted on various investiture and acquisition related topics. Nick, as always, we so appreciate you joining all events that we do, and it's been so wonderful collaborating with you over the years. So welcome to Food Edge, and over to you to start the conversation this morning.
Thank you so much, Lauren, and thanks for putting this on. I know it's challenging doing these things during COVID. It's a totally different playbook. And thanks for the introduction. Basically, in a nutshell, what we do at Whipstitch is we help companies raise money and we help them sell. And a very big part of that is figuring out where is the value in the brand looking forward, and how do we show to investors and companies that are buying what that value is. And we've had years of work on this and years of knowledge learning from founders and what has made their brands work and not work. And it's actually one of the most humbling things, watching founders go through the growth of a brand, because it is so complicated and everything is different. Every channel is different. Every brand is different within every channel. So we've accumulated a lot of that knowledge over the years, because we can't be successful unless we make our brand, client partners successful. And I'm here to share some of these insights and knowledge that we have over the next half hour, 40 minutes or so. So starting at a high level, deal activity is accelerating as the COVID impact stabilizes. I think everybody had a knee-jerk reaction back in March, and you can kind of see how the number of deals decreased going into COVID and dropped. And I think that precipitous drop was really deals that were in closing process that got delayed and slowed down. And then as summer kind of came on, you're seeing how the deal count went up and the deal value went up a lot. We've actually seen quite a few large deals since COVID hit and has kind of mitigated. We've also seen a rise of IPOs in branded food and beverage, which is really unique, because over the last 20 years or so before this, I could probably count the number of branded product IPOs on one hand. And now there's been a few. Beyond Meat was recent, but we've had Vital Farms, we've had Laird Superfood, and we've also had a number of SPACs. A SPAC is a special purpose acquisition company. It's basically a public shell, which has gone public, raised a lot of money to buy one company. And the good thing about SPACs for founder companies and investor-backed companies is they're going to increase the buyer pool for brands. Because once a SPAC buys its target company, gets it integrated, they now have some public company currency, they have more debt capacity, and they've also got cash, usually left over from the raise. And we're seeing SPACs be very aggressive right now in buying companies. So when you look at exit options, historically, the sale has been the primary exit option for food branded product companies. It's usually been a large CPG buyer. The revenue size of a target has increased over time. 5 or 6 years ago, it was really in the kind of 30, 40, 50 million range. And today it's more than doubled. When you look at the data, it's really over 100 million in revenue. Big companies are set up to run big brands. Brand managers want to run big brands. That means they get more exposure, the more challenges, they have more resources to do it. That's really what they're very, very good at when you look at them. SPACs tend to be, their kind of niche in public companies here is they're buying companies that, generally speaking, are about 100 million in revenue or more, and they're generally a little bit more mature. They're a little slower growth, but they have great EBITDA margins for the most part. And they're buying at EBITDA multiples, and then they're looking for add-ons that they can also use to augment that EBITDA margin. The good thing about SPACs for exiting companies is usually 40 to 50% of the existing shares get liquidated at the time. When you think about an IPO, it's usually something like up to 20%. There's a very heavy equity role in IPOs. A SPAC is also quicker. As long as the company has an audit, the SPAC can occur very, very quickly, whereas an IPO takes some time. The IPOs that are out are getting done at very high values, and they typically are very high growth companies with 300 million in revenue or more, or potential for that, and in a very hot sector. And Laird and Beyond Meat were very early when they went out, but obviously the underwriting thesis is for something very, very large. And then there's another trend that's popping up too now, and this is still pretty new. So not a great large data set, but more companies are also looking at reverse mergers to go public. And this is something that's been going on for a while in other sectors. But basically, this is a shell that doesn't have a lot of cash in it, and it agrees to merge with a company, and at the same time does a private placement, or a PIPE as it's called in the public world, where they go and they raise money from a number of investors to basically support the company and grow the company and have a little bit of liquidity when it merges in. And the valuations there really vary on that private placement. So there's not a great data set yet, but this is something to watch as yet another exit option going forward. So this makes us sit back and revisit our kind of thesis of you're building a company for one of two objectives. Historically, it's been to build for profitability. You're growing the company with the idea that you're going to sell to a large strategic. The more growth, the more velocity that you can get economically, the better. So you're putting a lot of money every year to have that first mover advantage and grow that brand. It's very, very attractive to a big strategic. But more and more, as the pool of potential buyers in the industry has grown, there's a managed for growth strategy, which is managed for profitability, which is managing for EBITDA, ideally 10 million or more, and then you're selling to a SPAC potentially, or to a private equity roll-up, or to some other mid-tier buyers. In the managed for profitability, you're not raising as much money. You're not incurring as much dilution. I actually talked to a brand yesterday, which is in beverage of all things, which is usually very capital intensive. And they were well into the double digits revenue, had not raised much outside money, and had EBITDA. And it's because they were following this strategy, and they had a unique way of approaching it. Distribution channels and managed for growth, conventional retail and convenience are really the most valuable. Convenience is tough with food. Not all food is compatible with it. But if you can get there, it's great because it over-indexes conventional retail. The reason it's so valuable is because that's where big companies play the game the best. And it really proves the mainstream appeal of a brand. If you're in managed for profitability, any channel matters. D2C, food service, even private label, they all add to EBITDA. They all matter in getting to that critical mass. They're important for managing for growth too, but that one prove out channel, Club 2, is very important. Valuation drivers, growth versus profitability, and we've talked about exit. So one way to think about your company, and I encourage people to look at this annually, even when they're younger, is on a few kind of key metrics. So how do you decide growth versus profitability? Well, you look at your growth rate and you look forward at your growth rate. Obviously, the higher, the more you lean toward growth. You think about profitability today and what it's going to be in the future. And by the way, public companies, when they're buying these growth companies, they do want them to be profitable at the time they buy them. So thinking about that early on with margin type decisions is important. Your run rate, obviously if your run rate is higher, if you are over 50 million in revenue, you're going to be leaning toward a little bit more toward the former, the growth. And then headroom. If you look at your brand and you look at the channels you're in with the SKU potential that you can have there, looking at some of the industry leaders, how much room can you expand your brand? Can you get to half of the convenience stores? Can you get to 70% of conventional grocery? Can you get into club? Can you get into the natural channel fully? How much D2C can you do? Add it all up, and that's your brand headroom. That's really important for both, but particularly important for growth. So what's going on in the market with COVID? This question comes up all the time, and it's honestly changing. COVID has done a number on the SPINS data and other data sources out there, and it's made it really hard for brands to figure out what's really going on with their product on the shelf. So I start by looking at the very, very high level view of the three universes in SPINS. TPL is basically all of the companies there. HWI is the 25% most healthy companies, and NPI is within HWI, just like HWI is within TPL, the 1/3 of it, or about 9% or so, of the healthiest of the healthy. The left bar here, in all cases, is February, and the right is October. So you can see over time how the trend has worked. We pantry loaded, and then we came down, and then we've leveled off. And just as restaurants have kind of continued to open, we've ticked down a little bit over the last few months. I think that trend is going to stabilize and potentially reverse as we see more and more restaurants going into hibernation in cold weather climates, but that data is obviously not out yet. What's really interesting here in thinking about COVID is, there's a thesis out there that COVID is making people look at healthier brands and, move more quickly, accelerate this move toward buying for health and not just, because they have money or whatever, and that's why they're buying healthy brands. And if you look at the HWI universe, you can see that today it is over-indexing TPL, and it's actually over-indexing NPI, but I think that signifies that a lot of the TPL, a lot of the conventional grocery buyers, including, by the way, millennials who are stepping in the store for the first time, which they did back in March and April because Instacart stopped delivering, are buying into this HWI universe. It's the first step from that kind of conventional group. And I think that's why you're seeing it over-index. There's a little data quirk here. It looks like it really started over-indexing back in around May. The data quirk is that HWI captures energy and convenience. And convenience was down in the first 3 months pretty hard from COVID because people were not on the go. If you correct for that factor, you will see that in March, HWI actually over-indexed everything, and that trend has basically continued at the same level. So this was a very immediate near-term reaction to COVID. When you look at how does HWI over-index, we took a look at the biggest sales increase by dollar, biggest sales increase categories. No surprise, things around seasonings and baking mixes, healthier versions of those did very well. We see plant-based cheese and that's quite interesting. We're going to talk about that in a little bit. And then frozen is very big too. Desserts, frozen meals, entrees. If you're going to the grocery store once a week, you're buying a very big load. Some of that is going to be frozen, more than what was before. So we took a look at what is going on with the number of brands. And this was something that we actually took a look at just because we wanted to see how much HWI brands had increased this year. And when we looked at the data, we saw that they decreased. And it was actually very interesting because we said, well, geez, how is this over-indexing and the number of brands decreasing? And we sat back and thought for a minute. And if you think about what goes on as a category manager, you have 40 or 50 brands, let's say, in your category. You've got the top performers and you've got the bottom. And every year you weed out some of the bottom and you bring in some new brands, which are going to hopefully be somewhere above those. Well, this year, COVID hit at, unfortunately, about the worst time of the year. It hit right before Expo West, which is a very big trade show for expos and new brands. And it also hit right ahead of the spring reset dates in conventional grocery. There's a lot of products that between kind of March and June get reset. Like if you're an ice cream, they want to get you in right ahead to make sure you're in all the shelves right ahead of the busy summer season. A lot of frozen too. So there's a disproportionate number of categories whose resets got disrupted because the sales levels got so high, they just couldn't execute the resets when the priority was keeping things on the shelf. So what we're seeing in all universes is there was the removal of those brands because all of that was already in the planograms, and basically there were multiple facings put of the brands that were there because there was so much demand on the shelves that they just added a facing to kind of get by between that, then and now during all the increase in traffic in stores. And you can see looking at last year versus this year, the left bar versus the middle, it has been pretty flat, this number, because as they've churned out, they've come in. But this year we're missing that coming in. And I think that's going to hopefully reverse over the next year as things stabilize a little bit more and hopefully over-index the other way as these multiple facings shrink and new brands come in. Supporting that further here is if you look at the velocity of conventional products, they've basically over-indexed in March and they've kind of come back since then. The increase in velocity in all three universes is about the same. But when you actually, when you think about what's happening here, in TPL, you have a lot of things like toilet paper. And I don't know about you guys, but I know I still have more toilet paper than I had in February. And there's other things like flour. And I'm sure that, if everybody looks around, there are still some TPL products, some core staples that are probably sitting in higher quantities than you've had before. So if you actually kind of back out that somewhat quasi-permanent pantry load from there, the velocity of HWI and NPI are actually trending above TPL here too. So when you kind of put these together and you look at the number of placements, now this is distribution points. This isn't one face in one store. This is one SKU and one ACV. And an ACV, remember, is 1% of a channel. So 1% of the MULO channel is, let's call it about 225 or 30 Stop and Shops, just to put it in perspective. If you have one SKU and that many of those stores, you would have one distribution point by this measure. If you look at the last 3 years, the number of distribution points has been level in TPL and declining this year, as expected, because of the multiple facings. And if you look at NPI and HWI, the healthier channels, they actually rose 2 years ago to last year. And I think they would have risen a lot further this year if we had had the resets like we thought. Looking at the 2 years, you can see how the healthier channels are overperforming the conventional, mainstream products. So that's very encouraging for innovative brands. I was giving a webinar earlier this week, actually with our Whipstitch group here, and somebody asked the question, what is happening with price points? Are price points of healthier brands getting lower, and what's the trend? So we had to actually run the chart just to see. So here's the answer. The price points are basically holding where they are. Surprisingly, NPI is not as big of a premium, that's the healthiest of the healthy, to TPL, which is everything. HWI is actually the highest premium. And you can see in this chart how the prices rose going into April and May as people pulled back on their trade spend and then kind of came down. You can also see how the healthier brands are aggressively going ahead of the conventional brands in increasing their trade spend. So digging more into that, back to our February through September of the 3 universes, you can see how, if you look closely, in TPL on the right, you can see how the big brands have more power, and they were able to very quickly pull their trade spend back to a greater level. That's why they got as low as 0.63 where they were in February. And if you look at HWI, you can see they only were able to get down to 0.69. You can also see how they ratcheted their trade spend right back much more quickly. So they're now at 1.08x February levels, and they're over-indexing by 107. So they're actually at February levels, while big brands are not even trade spending at February levels, still over-indexing. So if you're a healthier brand right now, know that if you're competing against other healthy brands in your category, know that on average, they're probably over-indexing their spend relative to how they were last year. There's definitely a trend in our industry that people buy products because they're moving into health and not because they have money. And we've actually seen this over the years in how natural products grow compared to conventional if you map that against consumer income. It's really evident when you look at what happened after COVID with private label. You would think that as we're going into a recession here, as people were laid off, that private label would be taking off, but the opposite has happened. It's actually declined a full point, going from 20% roughly to 19.0 in the last, in the 3 months of May, June, and July. That's a very, very big move. That's basically 1% of all grocery sales decline. And that also just signifies how people are trusting brands as they're making the decision to buy things that are healthier. Plant-based, everybody's heard about, plant-based doing well. I think it really helps if you look at the main categories and you look at how it is over-indexing the kind of conventional non-plant animal-based alternatives. So you can see as you look across meat, cheese, milk, ice cream, etc., how plant-based is growing comparatively. And if you remember back when we looked at what is making HWI over-index, plant-based cheese was the number $2. It's indicative that this is something that, even with people eating more candy and drinking more alcohol and everything that people are doing to indulge during this time, they're also over-indexing on healthier things. This trend of over-indexing healthy actually shows up in private label too. So we took a look at all of the private label categories and spins, and we looked at the categories that have a private label organic. And there's actually not that many. I can't remember the number, but I want to say that it was probably less than 20%, if not less than that. You can see how private label organic over the last 3 years has over-indexed the private label in total. So we said to ourselves, is it possible that the private label organic categories are just healthier categories? And are they perhaps over-indexing because the category itself, like plant-based cheese, is something where more dollars are going into it? So on the left, the private label non-organic is actually the same categories where the private label organic exists. And on the right, private label all is all of private label across all of spins. And you can see there is no significant difference between the private label in these categories that have the organic and the private label all. So it is truly the fact that the private label is organic that's causing it to over-index. Another sign that people are buying healthier food, even in any place they're making a choice. So shifting gears here and thinking about founders in the audience and investors, thinking about the kind of annual budget and how do you plan for the future and create value in brands, what are the high-level considerations for brand success? So stepping back, one thing that we've seen over the years is if you look at a brand, when a brand sells, every brand has a fundamental value. It could be 10 times EBITDA if you're a 10 million EBITDA brand. That's a great, 10 times EBITDA is a great market multiple for a company that size. And on top of whatever the fundamental value of a brand, there is a real estate premium. And I call it a real estate premium because there's only one brand that is your brand. There's only one Coca-Cola. Coca-Cola is always said to have a great deal of brand equity. There's only one. You can't have that brand on any other package. So your brand is your real estate, and if somebody doesn't buy it, somebody else is going to own it, and you can't recreate that brand exactly. That premium, that real estate premium on it is the brand's brand equity. And when you're building a brand, you want to do everything you can to build as much of that as possible, because that is basically kind of free value, for lack of a better term, because you're going to be building revenue and it costs money to do that. You're going to build EBITDA, and it costs money to put automation and all the things you do to be profitable and do the marketing to get consumers to buy. But building that brand equity while you're doing all that, that's where the excess returns are generated. So if we think about brand success, how do we break it down? Well, what's your objective? Growth and profitability. We talked about that. I think being very clear on that early on and switching if you need to over the time, that makes dilution minimized because you're really spending your capital wisely, more wisely. Your track record. I don't mean your track record in your P&L. I mean, what channels have you proven out? Have you proven out conventional? Have you proven out natural? Which SKUs have done it? Which subcategories have you expanded into that have proven it out? That's really important. The more that you prove out other subcategories and more channels, the bigger your brand can be. Obviously, you don't want to have subcategories in 25 places in the store if you're going to sell for growth because you want it to fit under one brand manager. But if you're doing it for profitability, that's just fine. Headroom, we talked about that. How much low risk growth is left? Not high risk, but low risk growth. Margin, what's the profitability potential at exit? So early on, and actually for a lot of the brand's life, gross margin is really the best indicator of this because the amount of gross margin that you have enables you to spend money on marketing and other things to build a brand. It's also the biggest EBITDA margin potential for the buyer at the end of the day. And then lastly, what are the rising tides? The best thing you can do is start a brand and position it in a place where you're going to have basically uplift in sales and customer interest that you don't have to pay for. So if people are all of a sudden plugging into whatever trend that you're in and they're buying your products because they know about that trend, that's a rising tide. You're not paying for that customer trial. It's happening. Big companies like permanent, long-lasting food brands that appeal to a wide customer base. So again, building brand equity, what do you need? You need authenticity in the brand. It has to be on trend for the long term. Some trends are short term, some are long term. You can have brands that subscribe to a short-term trend and they expand the brand because the brand was built so well that it's able to morph and go into other trends that weren't necessarily core to the brand, and the brand wasn't limited to it day one. Appealing to a wide customer base. This is what big companies do really well. They can find every pocket of demand and every usage occasion for every one of their products, and that's what they do really well. The more that you can figure that out early on, it demonstrates to them that they'll be able to do even more. Multiple usage occasions and critical mass, and then of course having strong intellectual property is really important, but consumers making a 2-second decision on the shelf, they don't understand the technology behind a brand. They just know it tastes better, or they know the packaging looks really good, or they know the brand and the trend and they understand it. One brand doesn't own the market. There is white space everywhere. You can have a leading brand in one subcategory, and then you can have 2 or 3 brands that are actually creating a whole different market within that subcategory. This slide I actually borrowed from New Hope because I wanted to make the point, thinking back to my days in technology, there was something called the Gartner hype cycle, which I think probably appeared in every single pitch book I ever saw a company take to a VC, venture capitalist. And, you know, in our industry, you know, what makes a brand work and kind of trends and things like that, it's a little more heterogeneous than a kind of set hype cycle in technology. But I think it's still really important, and it's been very difficult to date to figure out what is the kind of trend dynamic behind where you're going, and how does that, you know, how can I kind of leverage that to grow my brand? So one way that that they do it here, this is this new Next Data and Insights package that they're doing, is looking at media mentions and growth and volume. And this is a really good way to do it, because if you look at things that are high growth and high volume, well, those are great places to kind of build a company and find white space, because you know it's growing within a population. You know that as more and more people kind of, you know something and understand it, you're going to get more trial. Mature, that's not a great place to start a whole brand, but it's a great place if you want to expand your brand to get a little bit more revenue, because you know there's already a very, 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 very big base of people that understand whatever that trend is. So if you're at 80 million and you look at something that's in a more mature area to get the other 20, you know you're not going to have to spend as much in marketing, but it may not be as big of an add to your brand because it's mature and possibly, you know, possibly shrinking. And then emerging is obviously things that, this is where kind of founders are looking very, very early on for things that are going to be the big power trends of tomorrow. And this is what founders do so well, is understanding the consumer need here to pick, you know, to pick the white space that's going to work. And it's very difficult to do. And so that's kind of the, you know, that's kind of the early on piece. So thinking about this, when you're thinking about your, the growth in your, you know, the growth that you're projecting and how you support those projections, the velocity gains that you have is very important. And I think we look at sell-through in a company, we look at sell-through in category trends. It's also really important to figure out what are the trends in customer preference, customer knowledge, and, you know, demographics looking at brands. When you're growing a brand, it's important to think both about short and long-term opportunities and to grow it and build brand equity. And this is really tough. Big companies do this very well. They have trade spend that they have to do. They put, you know, the end cap of Cheerios, and it's probably marked down, but they have the end cap, which is great. And then they have a lot of things to build, you know, long-term brand equity and marketing. So TV commercials, things, you know, that they can do around sustainability that can be done with a supply chain as large as it is. And if you look at our industry, we're about a $250 billion industry. We spend about $25 billion a year on trade spend. And that's a very big number. If some of that trade spend, which is really a short-term thing, you know, you put something on sale, somebody buys it, you're going to recapture some of those people as permanent customers. But if you have a very deep discount, you have to train them that your price point is going to be higher. But it's very difficult for a small company to do anything that's broad-based marketing outside of social media. So that's obviously a place to focus on the left side of the fulcrum, and redeploying some of the trade spend dollars there is helpful. And also sustainability in your supply chain. You know, people, profits, planet, thinking more broadly about the whole brand ethos, because if you infuse that early on, that's your best opportunity to do it, to define your brand early and capture that. And as millennials, you know, age and the customer in this population focuses more and more on the profits or the people and the planet part of the 3P model there, this is very important. One way that you can empower yourself to do this, to reduce trade spend, is to think about this. The natural brands are very they don't have the price elasticity that conventional brands do. Conventional brands on average, for every 1% change in price, have a 4.5 times impact compared to natural. And we got this data by taking the top 20 brands and spins, and then we took 20 brands that range from 3 to 22 million, basically the largest brand in each of those $1 million buckets, brands you would know, and we looked at the last 2 years, month by month, change in price, change in volume. And it's very clear that people are they're buying healthy brands, not because they're on sale. Granted, there is some access, economic access that happens with a deep discount, but they're buying them not because they're on sale. They're buying them because they want to get into healthier brands. And the depth of the sale doesn't matter as much. It's more important that you've got that tag or whatever it is that's associated with the sale that's drawing attention to the brand to get them in. So if you don't have to discount as much, you can take some of those dollars, run the same number of promos, and repurpose them to longer-term marketing, social media, and sustainability. So in thinking about the People Profits Planet model in a little more detail, in the last 20 years, there's been a lot of kind of buy one, give ones. And over time, it's really grown to this People Profit Planets. And this is, again, as millennials are growing up, this is a really important dynamic of brands, thinking about what are the rising tides, what is going to create brand equity in my brand that I'm not going to be paying incrementally for in the future. The more this happens early on, the more you won't have to do that. So talking about planet, this is a bit confusing out there. And this is one of the hardest things, I think, for mainstream consumers to grasp. If you think about organic started in the early to mid 80s, really. And I think organic hit about $1 billion in 1990. And here we are 30 years later, and organic is still a minority in the stores. People understand organic is good, and that's how they make the decision in mainstream. It's one word, they get it. So if you think about the next phase here, which is really regenerative agriculture, that's kind of the organic 2.0, it's a very difficult concept because if you can read tomes of information around farming practice and things like that, but basically what regenerative agriculture really is increasing organic matter in soil, or OM+, as I have it here, just to try to dummy it down to 3 symbols or 3 characters. When there's more organic matter, the soil holds more water. That means there's less flood risk. That means insurance companies can insure crops that they may not have been comfortable insuring in certain locations before. Carbon sequestration, the more organic matter is carbon. The more organic matter that's in the soil, the more carbon is sequestered. That's, all this movement to companies that are producing, net carbon neutral or net carbon negative, that's how they're doing it. Improve nutrient density through biodiversity, food tastes better. There's just lots of reasons why this is important. And this is when we say planet and supply chain, this is really the future right here. In 5 or 10 years, if you're not going to be able to adopt this fully day one, but the more that your supply chain is sustainable and leaning this way in the long term, it's going to be a rising tide. On the people side, there's some really great data here to share. And if you think about Ben and Jerry's, I just love this story. Ben and Jerry's put out their solidarity statement on June 3rd. And if you look instantly in June and July in spins, their sales very quickly over-indexed other brands. Now, Ben and Jerry's could uniquely do this because from day one, they were a people-focused brand. Think about the way, all the marketing around how they paid people. And, the CEO didn't make more than 7 times the lowest paid worker. They've always stood for JEDI, or, justice, equity, diversity, inclusion. They've always stood for that in their brand. So they're uniquely able to do this. They didn't put that statement out there to make money. They probably had no idea they were going to over-index like this. They did it because it was authentic, and the consumers recognized that. Consumers are really smart around authenticity. So the decisions that they made early on are benefiting them even today. And if you actually, this is June and July, if you look at their numbers over the last 2 or 3 quads and spins, which are really months, 4-week periods, they're still over-indexing about 5%. And that's from one thing that happened in June, from one decision they made, decades ago. I think it also helps to look very broadly at the world at a high level for other evidence that, that things around people, gender equality and things actually make economic sense, and try to put dollars and cents behind it. So if we look at gender neutrality here, the World Economic Forum did a report where they looked at all the countries in the world and they ranked them based on gender equality. And so what we did is we took a look at the top 5 countries there, and we put US and Canada on here, and we looked at what happened to GDP over the last 20 years, GDP per capita. So this is basically the output of these countries per person. And if this was a group of emerging market countries, countries that are, much earlier economies, those countries are all growing very quickly because they're growing from a lower base, so the percentages are higher. But this isn't. This is New Zealand and Iceland and Norway. These are, European developed countries. And you can see that in almost every case here, and definitely by the average, they largely over-index the US. So that if you think about a football team, if you practice and play half the team, you're never going to do as well as the team that plays them all. So it's really powerful data when you think about it. So what is broad-based marketing, and why do you have to do it? Well, if you think about growing a brand, and what happens is you expand your storefronts, any investor has probably seen this, and brands that are larger too, you reach a point where your dollars per TDP, or your velocity, dollars per SKU per store per week, starts to go down as you increase your ACV. And this happens particularly strongly on average after about 30 to 40 ACV. That's the percentage of the MULO or conventional grocery channel that you're in. The reason is you're getting into stores, you tend to pick the best stores and best banners first, and then you start to get into stores which are less productive, and just from the position of the store or whatever, and you also start to wear out your customer base. You get to a point where even at 40 or 50 ACV, pretty much everybody that wants to buy your brand can buy it. And so now, as you expand further, you have to balance expanding your customer base. In fact, if you take a look at what happens on average when a brand increases ACV, the change in ACV each year, as it goes up, the faster you're growing, the more that your velocity, dollar per TDP, or the less your velocity, dollar per TDP grows. Now, we ran this chart a year ago, and this chart was very linear, where basically each of these bars was about 10 or 12% lower. So when you were above 3% ACV growth, you basically at that point had velocity dilution on average, and we're averaging all the companies and spins doing this. The reason why this chart has changed, and this is such a great example of how COVID has made sell-through data a nightmare, and just made it something that you really, really have to be considerate of and think through before you start putting it in front of investors and buyers. The reason this chart has changed is because of the COVID bump. COVID has pushed up sales this year. So every one of these bars is now overstated about 10% compared to last year. When we run this again, if the COVID trend continues, it's going to look the opposite. And this is just a great example of why you need to be really thoughtful on how you take a look at COVID data in all angles. Thinking about channels and how you grow, and we talked about this earlier, channels are kind of a tool for growth. If you want to be a big brand selling to a big CPG, proving out conventional or MULO is really the most important thing, because you need that mainstream appeal. But how do you get that? How do you kind of get started? Well, natural has always been great for product discovery. It's more of a shopping experience. People take more time in making purchase decisions. It's 5 seconds, not 2. They pull the brand out, they read the label, much more than they would in mainstream, where they might be shopping off a list, particularly when you're shopping once a week instead of 2 or 3 times a week, and you do have a bigger list. At least I do, because I never remember to get everything, and I always buy lots of stuff that I didn't go for. Club is a great tool at driving velocity and volume. And it can actually be a very good profit tool, because Costco in particular is very, very efficient as far as getting the product from your co-packer to the shelf with the margins they take and the way to get to the market there. Convenience is incremental velocity. For beverage, convenience over-indexes MULO 2.5 to 1. And for food, it's about 1.5 to 1. So if your brand and your category can get into convenience, that is a great tool for incremental velocity. The usage occasion tends to be discrete. You go to conventional, you're buying for the week. Convenience, you're filling up your tank, you're eating it, drinking it in the car. You're not going to go out of your way to buy it if the convenience store doesn't have it. And then online is more and more important, and actually getting recognized more and more by big CPGs as a very valid channel. It's a recurring contribution margin. It's a great way to minimize dilution. If you can grow online early on, I've seen companies get to 20 or 30 million without having to raise any money, because they can be profitable super early online. And larger CPGs are recognizing this as legitimate revenue and not fragile. Thinking about growth, and when you're showing a plan to a big strategic or to an investor, you have to think about the growth that you're projecting and what is driving that growth and how much risk is associated with it. So new SKUs in your current product, new flavors, sizes, multi-packs, whatever it might be, that's the lowest risk. You've already proven the product, you're in a channel, you're just doing what you're doing with a different flavor. New distribution is a little bit riskier. You may not have proven a channel out. You're saying to somebody, hey, we can get into this channel, we can make it work. And you can hopefully offer some data by other products that are in your category that are better for you that have done well in that channel. And you can find the data for that and support it with it. But it's very, very important to be able to do that because you can't get headroom on your brand without these additional channels. New categories. And this is an interesting area. So if you're in something like frozen meals, you look at all the brands that have done, that are larger in frozen meals, they tend to be in multiple subcategories. Look at the Gardeins of the world and Amy's. And they're in multiple subcategories within freezer doors that are very close together. And their actual sell-through in those categories is not as high as like frozen pizza, which tends to be very, very high, or some other categories. So you have to be in multiple subcategories to be able to get to a large brand. And one brand manager can manage all of that. But if to make your brand larger, you have to be in frozen and snacks and condiments and produce, there's no one brand manager that does all that. So that's a very viable strategy when you're thinking about getting to that 10 million EBITDA and having a brand that's in multiple places. It's a great strategy for a big brand, but it can be limiting as to your buyer for large CPGs. And when you're thinking about your business plan and convincing investors and strategics where you're going to go, new categories are definitely more risky than new channels, taking your brand to someplace that's not. And then obviously new brands. Having a multi-brand platform is only an exit for profitability strategy. It's a very good one. We're seeing a lot more M&A with these SPACs because of that. They're building a lot of value by doing that and getting the synergies of cost consolidation and using their playbook to grow other brands. But if you're thinking about multi-brand, you're really going down that road, and it's kind of hard to unwind it. It's very hard to change one brand into another. So because this presentation is going to be available for everybody, I wanted to put these last two slides in because these are really good slides to think about as you make decisions. And again, there's building brand equity, which we want to be able to do, and we want to get that kind of intangible value on top of everything. But when you think about the core value of the brand, underneath that, what drives that? Because that's the tangible thing that in the near term, investors and strategics are going to subscribe to the most easily. Whereas brand equity is super important, but you can't sell people that you're going to get X amount of brand equity. It's very hard to have data that proves that. You can certainly say I've done X, Y, and Z that's going to build that. It's going to make that happen, but you have to get from X to Y before you get Y to Z. So obviously revenue, the larger the revenue, the more proven your brand is, the more you've proven channels to get there, the better. You're going to get a higher multiple. You are going to have more brand equity with a larger revenue company, particularly as you start to get over 50 million. You can show people evidence of that. Gross margins, you have to look at your category. You can't just look at the number in a vacuum. People always say, what's a good food gross margin? Well, if you're in frozen meat-based meals, it's probably not going to be over 30% as an independent company. But if you're in supplements, it's probably, and it's kind of pressed pill type things, it's probably not going to be less than 60%. So it really depends on your category. But look at your gross margins, look at where you can get them when you're larger, and make sure that there's going to be enough room for a good EBITDA margin, and make sure that they're not way out of whack with what's in your category now. And by the way, self-manufacturing companies, you also have to think about your capacity utilization. If you're a non-seasonal business, between 75 and 90% is typically where you're going to be optimal on gross margin. If you just built a new plant expansion and you're down at 30 or 40%, you're going to be suffering. Your overhead is going to be spread over, spread more heavily over what you're doing. You're probably losing 5 or 10 points. You can do an analysis and show people that. It's very valid. Strategic investors get that. And in fact, sometimes having that capacity and the ability to do more private label and do more production is actually valuable for a big strategic, particularly right now when volumes suddenly spiked and supply chains are challenged. Obviously growth that's velocity driven, velocity that is increasing and increasing in multiple channels. Distribution, more channels, obviously better. And capital efficiency, you really need to look at capital efficiency on the last 12 months, and you need to get your losses, your losers out of there. If you expanded into a new product line and it didn't work, isolate that as best you can. What did you actually spend to get the growth of what you're going to be doing going forward in the last year? All brands have missteps. All brands have pivot points. there's going to be a year in the history of the brand where you spent a lot of money and you didn't, maybe get as much for it. If you're in alcohol and you have to go state by state to get licenses and permits and DSD contracts, you're going to spend a ton of money before you even hit 10 million in revenue. And those are investments. That's not burn, that's an investment. So thinking through capital efficiency more thoroughly is very important. Brand extendability, this is again partly brand equity, but being able to get into other categories and back to the trends, being able to morph and encompass more than one trend is important. Simplicity, again, customers don't understand technology in a 2-second decision. They don't understand nutrient density unless they actually look at your label. How can you get the story of your brand and why they should be buying it into their minds quickly? Price point, obviously, you can see from the chart before, there is a premium of 20, 30%, but if you're 200 or 300% higher, it can be really tough. And the last recession, those were the brands that got hit the worst, the ones that were 2 or 3x the conventional alternative. Frequency of usage, obviously, if you can take a brand and you can come up with something, keep your current product lines, but come up with a way that people can consume it more quickly, single serve, whatever it might be, things that they can eat in the car that are shelf stable, the better. Look at customers. Again, this goes back to the trend data. If there's something also called panel data, which you can get from vendors like Spins, which shows what are your customer demographics. What are they switching from when they buy your brand? What are they switching to when they stop buying your brand? What else is in their cart when they're buying your brand? These are very, very important things to investors and strategics also. Your category, everybody says, what's a great category? I get this question all the time. And the truth is there's white space everywhere. 15 years ago, nobody liked frozen. It was so expensive and the slotting is horrendous and all that. But there's a lot of innovation and a lot of brand value being built in frozen today. And then obviously team. And your team is beyond you. It's beyond your people. It's your board. It's your friends in the industry. It's a much broader thing. And with that, I'm going to pass back to Lauren for Q&A.
Thank you very much, Nick. That was fascinating data and presentation and window into all that's happened over the last couple of months with COVID and how it's impacted grocery and retail. So thank you. So we did have a couple of questions come in. Nick, I know you can see them as well, so I will do the voiceover, but feel free to check the Q&A where people can submit questions that they may have for your presentation. So looking at the charts where organic has outperformed conventional versions of substantially similar products in private label, for example, did you filter for elasticity due to product availability disruptions?
Oh, that is really hard to do. So the answer is no. No, we didn't. And we did do it over multiple years. And one of the reasons we did that, and we didn't do it monthly during COVID, is that reason that, there are stockouts. One of the things in Spins data is that you get a max ACV more than a weighted ACV. The weighted is actually kind of a more premium product. So everything we do is based on max. It's kind of what we have access to. So if you have a quad period, a 4-week period, and a product happens to hit the shelf one day in that period, there's one sale, that gets counted in the ACV. So it is actually, that's a noise feature that's actually very hard to kind of filter out. But that's why I looked at multiple years.
Great. And are there good ratios for strong capital efficiency as you think about products?
Yes and no. So there's a point where kind of $1 spent, equals more than $1 in revenue. And, if you're a beverage, kind of classically, before people are kind of building brands for profitability and doing it in a way that, that will actually reduce the amount of capital spend. Classically, I would always have said, once you get to about 10 million in revenue, you should start to get to the point where that ratio changes and, every dollar should get more. But it's actually really tough. And the other thing that makes it really difficult is, and we were actually talking about a brand the other day that's in this situation, you could be spending very heavily and doing it very effectively. So I'll give you a great example. This particular brand has margins that are kind of in the low 20s, And that's not, that's a fairly low margin as people look at it in a vacuum. But when you actually looked at their data, they were trade spending at twice the rate of people in their category. And if you looked at the baseline, the sales non-promo, which is something you can see in the data, that baseline was going up pretty reliably every month. So if you think about what would happen to that brand's profitability if they cut their trade spend down, if they weren't growing as fast, that's another consideration. They actually had a big ACV expansion, which means more slotting. But if they weren't growing as fast, what does that do to profitability? Suddenly you realize, geez, this brand is actually fairly capital efficient. But in a vacuum, it looks like they spent a lot of money. The key is they got a real economic return for it.
There's more to the story there. Yeah. And then with regards to health, sustainability, social impact, social mission, based on the data, do you advise startups to kind of focus on a certain message? I think that for a lot of companies, they struggle with, what to put at the forefront of their marketing and branding. Based on what we've seen with regards to some of the data that you've presented, do you have advice for any startups that are coming to market and trying to select which message to put at the forefront?
No, because I think it really has to come from the heart. Your brand is your vision, it's your baby, and if it's not authentic, then that message is going to be, it's going to get filtered out by the customer really, really quickly. I think the high-level framework of People, Profits, Planet, and figuring out what you stand for and what you want your brand to stand for there, that's that important framework, I would say, is what you should look at. But I think the way that you see that and how you want to grow that brand, looking at the unique white space opportunity in your category and what you personally believe in, that's really what counts.
And I'll wrap up with one last question here, because I think it's a theme that we've heard throughout the last couple of days. Sampling, as you know, has become a huge challenge for many brands. It's virtually impossible these days. Any creative efforts you've seen on behalf of companies that are able to sort of overcome that hurdle of not being able to sample, but anything that you've seen in the market that's been particularly unique and in terms of how companies are navigating that barrier now?
I haven't seen anecdotally anything that's been particularly powerful. One thing that I have seen, though, is that the online sales of brands, and I'm putting refrigerated and frozen in there too, which is really unusual, has increased dramatically during COVID. I know one brand that's in frozen that went from a couple million a year to over $1 million a month at one point. And in frozen, it's really hard, to ship online. So if you have a social media campaign and you've got something online and somebody can just click and buy on Amazon, people are trying new things, particularly if you reach them. That's probably, the best advice. And by the way, you get the benefit of building your brand at the same time.
Absolutely. Well, Nick, thank you so much for your time today. We really appreciate all of the insight and data you guys are at the forefront of, and your willingness to share it with our community here that are tuning into Food Edge. So thank you very much. Very much appreciate your presentation.
Thank you, Lauren. Happy to do it and, enjoy it immensely.
All right.